Good morning. So I have my chat open as well. Can't see anyone since we're on a webinar. So if you have questions, please plug them in the chat. And as we go through this class, we're going to start out with a broad overview of 1031, just very basic for a few minutes, and then dive into these frequent 1031 exchange mistakes and pitfalls to avoid. So what that means is how, as realtors, can we avoid those big red ticket items when we have the red flags raised right by the IRS? So we really want to avoid those items, of course, and just lead with the best example of professionalism if we are working on a 1031 exchange transaction. So that's really today what we're going to be covering. I know some of you, when I do these classes about 3 times a year, some people are very, very in the dark with 1031 exchanges. That's why I like to do that overview. Some of you want to know more about, calculations and what it is for full tax deferral and a little bit more intricate. So we will also cover that. And then, of course, my name's up there on the screen. I'm Kayla Farking. I'm the Vice President with Leader 1031. We cover all 50 states for 1031 exchanges, and we're very rare as a qualified intermediary. So what that means is we're bank owned and operated. So a little bit unique in who we are and our presence. So we're more nimble than other QIs that you see out there, but of course, smaller is nimble, right? So great to meet all of you. And Bridget, I know you're asking for the handout. Can see if I can drop it in there unless Elsie, I think she's on it. Okay, perfect. Thank you, Elsie. Appreciate it. All right, we're going to kick this off. And as we go through the 9 different pitfalls, I'm going to pause after each pitfall for questions that you have pertaining to each one. That way, if you want to plug things in and you have questions, we can really focus on that topic before we catapult forward. So first and foremost, I'm not a CPA. I do not give legal tax advice. We say that very frequently, right? With our roles as realtors, brokers. If you have a client that's asking for tax advice questions and what will I be paying specifically on my capital gains taxes, that is not for us to answer. Okay, that is for them to consult with their legal tax advisor. Sure, we can discuss the levels of capital gains taxation, but when it comes to specifics, we always will redirect them back to their CPA. I've been in the real estate industry, that should be about 15 years now. I've been in the 1031 exchange space for 10 years of my real estate career. I'm licensed in California, getting my license in Idaho, working on Nevada and securities. So as I mentioned, we cover all 50 states. The headquarters of my company is located in Boston. So we do a lot of closing attorney states as well. So there's not really too many exchanges I haven't gone through and visited in my 10 years of experience being a QI, qualified intermediary. That's what we do for hold money in the exchange. And I got into the industry through family investment. So my family was very, very heavy into real estate investments in their 30s. My parents owned properties and then sold them and paid an astronomical amount of capital gains taxes. So dinner table talk when I was in my early teens was fun, but kind of geeked out on the tax code language and wanted to learn more. So since then, I've worked for 2 huge qualified intermediaries that are title owned and operated. I'm sure you've heard of them. They're fantastic. So it's all about that relationship focus. Where now I'm really honing in on that security of funds. Parent company is Leader Bank. If anyone wants to search, do your due diligence always on who you hire for qualified intermediaries. So starting out with the knowledge check, and it looks like I have a question, or no, thank you. I'll see that's from you. So starting out with knowledge check, if you don't mind responding and participating here, just getting a feel for audience and the volume of responses is great as well. So does anyone know what IRC stands for? IRC, when we're talking about 1031, if I say IRC 1031. Any takers? Give it a sec. If you have that handout, it might be on there, by the way. So IRC stands for Internal Revenue Code, right? So IRC 1031, that's a section of the tax code created by the IRS, right? So IRC section 1031. We've created this 1031 exchange phenomena. Let's exchange it. Let's 1031 it. But in the basics and what you take away from the meat of 1031, it is an internal revenue code section of the IRS tax provision in our country. Now, when was IRC, Internal Revenue Code, Section 1031 added as a tax code? Oops, I have the Q&A. I want to move this down too. What about that? Ah, Joel, you did answer. Thank you, Joel. So when was IRC Section 1031 added as a tax code? Does anybody know? How long has it been around in this country? The answer to number 2, I don't see anyone responding to that one, is 1921. Someone at 19, Joel, close, 1913, 1921, right? So that's a long time of exchanges. We've obviously had a lot of regulations and revisions, advancements, I should say restrictions is the main one in the tax code from what we see today and how it was back in 1921. When does the exchange period end? We are all about timelines and restrictions, right? So in the 1031, does anyone know the entire amount of that timeline? How long is it from start to finish, where you start at close of escrow of what we call as the relinquished property and the close of escrow on the replacement property? You have this set timeline and it's a certain set amount of days. Any takers? Patricia, Sean, thank you. Joel, appreciate it. So Joel's off by 1, very close. Patricia, Sean, thank you. 180 days. So those are calendar days, right? You're not focusing on the weekends, the holidays, all of that's inclusive. So that goes quick. 6 months is quick from start to finish. And of course, there's other nuances that are involved in that 180-day timeline. What is the maximum amount of capital gains taxes that you can defer? It's my final question before we move on. Any takers? Patricia, you're correct. There is, she said unlimited, no limit. Thank you. So when we're looking at the maximum amount, there was a potential of capping capital gains taxes listed in the Biden's family tax plan for provisions in cutting, right? So what they were going to do and what the proposal was is let's cap how much you can defer at 500K. So if I have 500K gain, I can only exchange my basis plus my gain, right? Up to 500. If I have any gain over 500K, then I'm paying taxes on it. That did not happen. So this is my fun trick question, if you will. So thank you guys for participating. You can exchange sky high. You know, I have a deal we're working on right now that a gal is selling a property out of Nashville. She bought it for 150K. It's valued at 300 now, right? So she has gain in the amount of 150. I'm also working on another exchange that's 13 million coming out of California that's commercial. So that gain, that person bought the property for 2 million and they're selling it for 11 million more at 13. Meaning in those two examples, there's no limit on how much you can defer in capital gains taxes. So let's talk about what an exchange is. We know it's an IRC, an Internal Revenue Code. We know it was created in 1921. Now, directly from the tax code, this states that no gain or loss shall be recognized. So no gain or loss shall be recognized on the exchange, so transaction on the exchange of real property, only real estate, held for productive use in a trade, business, or for investment purposes. Trade, business, investment, all of those apply, right? Commercial, maybe a vacation rental, land, all those. If such property is exchanged solely for property of like kind, which is to be either held for productive use in a trade or business or for investment. So how I hold my property as an investment and guaranteeing that it is real property, not personal property or a primary residence, then I can exchange it for a property held in the same way or like kind. It's like kind, it's similar to, it's an investment and it's real property. Takeaway here is it's the sale of one investment property followed by the purchase of another investment property facilitated by the qualified intermediary or 1031 exchange company in the middle. Okay, so facilitated. A lot of the time, my profession is called a facilitator or an accommodator. These are all common terms used for describing the legal term of qualified intermediary. So in order to perform a 1031 exchange, you will need the services of a qualified intermediary. Substitute that term for a facilitator or accommodator. Now, who are we focusing on as far as the tax and what are they doing, right? These investors is who we're focusing on. And what they're doing is delaying the recognition of capital gains taxes on the disposition of the sale of an investment property. So our common logic here is, well, I'm going to defer taxes. Defer taxes. Well, when do I pay taxes, right? A lot of people don't look at this strategy as a compounded real estate wealth strategy. So if I sell one and it appreciates, I defer taxes, I can buy two, I can buy four. I can start utilizing this tax code to compound my real estate interest and buy more real estate. For realtors, when we look at that through our realtor lens, you're looking at sales. Maybe someone sells one property and acquires two. That's three potential commissions. Then they're selling those two and they're buying four, right? So you're doing the math, and we look at all of these investors and how frequently they sell on average every 5 years, right? So if you're farming 100 investors, on average, that's 20 potential deals a year. So numbers don't lie, right? We're focusing on that. And of course, I breeze by the delaying of recognition. So yes, when we delay the recognition of paying capital gains taxes, what we're doing here is postponing it, right? If you're ever to pay capital gains taxes, it's going to be when you sell property and you collect money. We call that actual receipt of funds. You can keep exchanging until you die. We call it you swap till you drop. So if you swap till you drop and your beneficiaries inherit that property, then they're receiving a step up in basis, meaning the capital gains taxes go away. When the beneficiary inherits the property, they can sell the property for fair market value. Pretty neat. So rolling into a little bit more of history, I talked about 1918 when I talked about 21, but 1918, that's when the first, we had our income taxes created, the federal income taxes in 1918. So shortly thereafter in 21, there was the idea of, let's talk about real estate and what are we paying on this now with income taxes? How does it apply? So the concept of swapping properties came about in 21. That provision number started out as 202C originally, then went to 112B1. As soon as these different regulations in the mid to late 20s started passing, right, we were focusing more on how do we get the advantage, and some people call this a loophole. For me, it's a tool, right? How do we use the tools in our tax provision to grow our real estate portfolio? So that's what we're seeing here. And it's always good to have these little timelines remembered when you're meeting with a client. Oh, hey, don't have any fear. This has been around since 1921, right? Now, between 1928 and 1984, the majority of regulations remained unchanged, except for in 54, we had the amendment to the federal tax. So this was focusing again back on 1031. It transitioned from 202C, the original number, into 112B1. From 112B1, we went into section 1031. So you look at how the numbers are growing. Of course, 202 to 112B. I'm not the IRS. I don't write the codes, right? And we landed on section 1031 to be the tax deferred like kind exchanges. After this timeline, there was this very, very important court case that occurred. And for those of you who are maybe ChatGPT or Google happy right now, when we search 1031, a lot of the time we'll see this name pop up, the Starker Exchange. Okay. Starker was an actual last name of a gentleman, TJ Starker. In 1967, he informally created the delayed exchange. Delayed, and the term of a delayed exchange is the timeline that we had restricted in 1984. So this gentleman said, hey, I'm going to sell land with lumber attached to it to a gentleman who I'm not going to collect cash from, but I'm going to tell him he needs to buy me replacement property or new real estate with the cash that I would have otherwise collected. But since I'm not touching it, I'm duping the IRS, or in a way using an exchange, right? So I'm not touching the money. Qualified intermediary wasn't really a concept at this point. So what happened was he took 5 full years to find replacement property. 5 years, that's kind of nice, right? So He said, all right, we'll take this property, that property, that property. So it took him a while and he diversified his portfolio while making interest on the lumber that was being produced on that land. So pretty neat. Of course, the IRS came after him and said, absolutely not. You're going to pay taxes on it. He fought that and won, thereby moving us into from 60s into the 70s after the 5 years of that transaction, court cases left and right for the Starkers into 1984 of why we see these 180-day timelines and 45-day ID period in existence. So those time restrictions were added on all exchange. That's why the word again is delayed. We're delaying the timeline. We're back in, let's say, 40s, 50s, we could swap. If I had an apple orchard and let's say Elsie had an orange grove, we could swap deeds. Maybe I was just out of the apple business, right? And she was done with vitamin C. So we could essentially swap. But when we're looking at that today, what about where my property is located and the value of mine may be more than Elsie's or hers may be more than mine in value and production, right? So we're going to look at the value of real property exchanging, but now we're restricted. We can't wait 5 years like Starker did, unfortunately. So when we look at the timeline, day of close on, here's a term, the relinquished property is sold. It's close of escrow. The following day starts a timeline of 45 calendar days to identify replacement property. That exchanger then has an additional 135 calendar days to close on only those properties that they've ID'd. So 45 plus the additional 135 if I need it, right, to close on what I ID, total 180 days. So the 45 is inclusive of that 180. Additionally, we saw interest in a partnership. You cannot exchange interest, right? We're back to basics. Real property, real estate. You cannot exchange into or out of REITs, real estate investment trust. While REITs can do exchanges themselves, if you're owning part of a REIT, those are shares. So you cannot exchange those, right? They're allowing interest in partnerships to be exchanged. Before we get into pitfall one quick overview, and I'm going to pause for questions here as well. In a traditional sale, you sell real property and you receive cash. Anytime we get a paycheck, what happens? We pay taxes, right? So anytime I'm in actual or constructive receipt of funds, I'm paying capital gains taxes. Now, constructive receipt of funds could be maybe I wanted to set up an exchange and it's a Friday and we've already closed and recorded where the burdens and benefits have transferred to the buyer on title. On Monday, I get a call from you and you're telling me, hey, I want to set up an exchange, but the money's in escrow. Unfortunately, that's constructive receipt of funds because there was no exchange agreement, which has an assignment. That means you're assigning the rights to sell and receive and pledge the cash on behalf of the exchanger taxpayer. So constructive receipt, if it's sitting in escrow and if it's not set up for an exchange, actual receipt, right? You're actually touching money. Those are all traditional sale components, right? That's just generic sales of real estate. Now on the 1031 exchange portion, it's when the taxpayer sells real property and receives more investment property. They're not getting there, I put a down payment down, I want that money back. No, they're exchanging the full sales price minus closing costs. That's your value. My value of real property, and I'm exchanging it for more like-kind property, right? So my value of my sale needs to equate to my purchase or purchases in investment property. Thereby, I'm deferring capital gains taxes. So real estate for cash, triggering a taxable event. Real estate for real estate in a 1031, deferring, kicking the can down the road of capital gains taxes. This is the last and greatest tax code available to real estate investors left in our tax code provision. I know a lot of people boast eminent domain 1033. That's the Internal Revenue Code for that. Sometimes that can be nice because you have a longer timeline, but how rare is that the government's going to come in and take your property? So this is actually a tool that you can use or push to use to your advantage or for your clients to grow wealth and you individually as realtors. So much advantage here to buy and exchange property and hold. Any questions on the format of the exchange, the differences of traditional versus the exchange, just before we get into more meat of the transaction? Okay. I have these open too, so if anything pops up again, just let me know, and then I'll revisit once we get through the first pitfall to pause. And please, if you have a personal scenario going on with a client and it pertains to that pitfall, throw it in there. I guarantee you someone else that's listening in the class is probably going through the same thing. So who am I targeting? These are the clients that are maxed out on depreciation, right? Max it all out, 27 and a half. Co-owner problems. We talked about partnerships. Maybe they're on title in, they're vested as tenants in common, right? I'm sure we've heard that a lot. We pull title with our title reps, they'll show us, okay, the deed's showing potentially 50-50 tenants in common, right? If it's 50-50, they can exchange into or out of that property and go their separate ways. If there's a partnership, the partnership needs to do an exchange itself. So an LLC, for instance, right? So maybe they're having co-owner problems. We can talk to those clients early on to break them out into a tenants in common capacity and get them set up successfully for an exchange down the line. Tired of being a landlord. While looking at the scenario of exchanging and representing a seller and getting the advantage of the buyer's agent opportunity for that same client sounds great. A lot of the time, people don't want to get off the fence to sell real property because then they're going to go back into replacement property. And we know the common gripe today is, well, I'm married to this 4.5 rate. Sometimes people have like 2.75. And if you do, congratulations, I get it, right? It's a good feeling. But people don't want to be a landlord. There are alternative replacement properties. And we can talk one-on-one about that as well, what DSTs are, and maybe that's for another class. These people want to relocate to another geographic area, huge during and post-COVID. If I'm going to move out of state, I want to bring my investment property with me. If I'm looking at traditional real estate, that's SFR, single family, right, residential, whatever it may be, I want to be able to manage it. Leveraging tax deferral benefits. As I mentioned, right, sell one, I can leverage that, maybe 2 down payments, buy 2 properties. Improving my cash flow, maybe something isn't performing the way that it was. Diversifying or consolidating as well. So we have a gentleman right now who's selling 7 different rental units in Huntington Beach. This gentleman is combining all those sale proceeds. I think it's around 18 million, and he's going to buy 1 large commercial building in Tennessee. So you can do a multiple property exchange, combine proceeds, buy something larger, right? Or the original of how we start to grow wealth and we compound that real estate wealth is maybe we sell 1 and buy 2, buy 3. The pitfall number 1. I kind of covered this, but let's take a closer look. This is what we want to avoid, again, a pitfall. Closing the sale of relinquished property without setting up a 1031 exchange first. This pains me to my core. It reminds me of my parents early on. They bought land in Rancho Santa Fe in their 30s, ended up selling it in their mid-30s, ended up selling it in their late 30s. I think it was Janet Jackson and some other famous singer came out and wanted to buy the land, Rancho Santa Fe in San Diego. They thought they hit the gold mine, but they sold it. They sold the property, collected cash, and wrote a huge check to the federal government because they weren't aware of tax deferrals in their 30s. So if they did know about it and they set up an exchange prior to close of escrow, they could have deferred capital gains because they are investors. They could have deferred it and bought more real estate, right? So if at any point you have a client, they're selling investment property, they need to have maybe an overview or a brush up course by their qualified intermediary, Kayla, let's say for instance. I'm happy to jump on the phone with you to talk about it. Maybe it makes sense and we can pause on the closing, right? We can talk to the escrow officers, take a beat, see what we need to do to prepare our exchange agreement and assignment, right? There's no opportunity to set up a 1031 exchange after closing. It's done. Multiple times I've seen this happen where I get that call on a Monday after you've closed on a Friday. It's all champagne. But unfortunately, when your client, thinks, okay, my trusted realtor didn't advise me to set it up beforehand. They just gave me the idea of the exchange and we didn't dive into actually preparing it. This is a blown exchange component, and that person is paying a ton in capital gains taxes potentially. So you hear an investment property, your ears perk up, non-owner occupieds. We can always set it up at the last minute. If I get a rush deal, we can do it in 20, 30 minutes, depending on how quickly we get documents from escrow and the client. Any questions on this pitfall? Okay. This is part of this pitfall. You may have seen this in the MLS. The buyer is aware that seller intends to perform an IRC Section 1031 tax deferred exchange. Seller requests buyer's cooperation in such an exchange and agrees to hold buyer harmless from any and all claims, costs, liabilities, or delays, right? So this is pretty much freeing up the buyer's responsibility and telling them they will cooperate with the exchange, but they're not responsible, right? We have this in our assignment. This covers it. It's a win for you as a realtor to have this either in the MLS or in your zip forms whenever you pull them open, right? You have your seller's intent to exchange. You have a checkbox option on your contract as well in your RPA. That just switched really quickly if you didn't notice, but it went from cooperation clause relinquished to replacement. So relinquish the property I'm selling, relinquishing it, replacement property I'm buying. So same terminology, just indicating that the seller, because you're now representing a exchange buyer, right? So that the seller is aware that the buyer intends to perform a 1031 exchange. Now, looking back at that timeline of setting it up, when is a good time to talk to a qualified intermediary? I could ask the same question about realtors, right? Whenever you're talking to someone who wants to sell with you at your listing appointment, right? You can do it a month, a year, 2 years in advance. Sometimes you're stacking that pipeline. So if it benefits the client to call us, to talk to us, maybe all of us together a year in advance, great. Because when we get to this timeline where the exchanger, also known as your seller, has listed their property for sale with you and an offer comes in the transaction, when that cash is sitting in escrow, at close of escrow, the funds are now wired into a segregated account that we hold on behalf of the exchanger taxpayer. So the qualified intermediary holds the funds within those certain regulations and restrictions or timelines of the exchange period. You find them replacement property. We wire an earnest money deposit over on their behalf after disbursements are signed, of course, confirmation of wire instructions, so on and so forth. We fund the remaining portion of the exchange using their funds and then direct deed title back to the exchanger taxpayer. So the difference here when we look at it visually, because I'm a big visual learner here, is the qualified intermediary is holding the funds in between the sale and the purchase of real property. And that timeline, can't stress enough. Start helping your client look ahead, right? Everyone has a WIPM on their head. What's in it for me? So if your client's WIPM is, I've always wanted to own a coffee shop. I want a piece of commercial real estate. Maybe you connect them with a commercial broker. Maybe they're coming out of commercial real estate and they want to buy rentals, right? They're performing better. So always looking ahead at where you're going. You can also be in contract with both the relinquished property and the replacement property at the same time. The exchanger does not have to use the entire timeline. They can, they need it. You know, sometimes we get those rush deals at the closing table. Hey, I want to set it up today and I'm closing on Friday. No problem. That really shrinks their timeline where someone else has an offer of maybe 30 days. They have 30 days to close escrow plus the additional 45 to formally identify replacement property. Buys them time. Now the identification period, that would be writing down an address. So let's call it 123 Main Street, right? That's the property that they identified. We need to receive a form that we send out to our client, completed with their signature and emailed back or texted, and I'll screenshot and send it so we have it on file, by the 45th day at midnight. If they do not identify property by the 45th day at midnight, the cash we're holding is then wired back to the exchanger taxpayer on day 46. If they do identify and use specific rules underneath the 45-day ID period, they're limited to only purchasing the properties they ID. So again, they cannot change those properties after they've reached day 45. They can beforehand. And of course, the 180-day exchange period that we covered, right? You have those additional days to perform. Maybe a new property comes up on day 40 and they want to add that to their list, right? If they add it to the list, fantastic. And maybe it closes on 30 days later on day 70. They didn't use the entire timeline, but they completed their exchange. So unambiguously describing property is the formal definition of identification. Common questions are, hey, I'm going to make 10 offers on replacement property. Is that an ID? No, you can write 1,000 offers. That does not matter. What we're looking for is a backing document that's a paper trail on behalf of the taxpayer for when they file their taxes, right? Sean just wrote a question here. Thanks, Sean. Is there a limit on the number of properties they can identify? Yes. So there are 3 different rules of identification. The most commonly used rule is the 3 property rule. This one specifically pertains, in my opinion, to residential real estate. If they're going to sell one, they may have a goal to buy 1 or 2. Okay. Sometimes they have a backup plan and write down 3. So their identification now has 3 different addresses that are maybe equal to on one property line each, or a combination of equality of what they've sold in some, right? So maybe all 3 add up to $1 million sale and all 3 are $1 million or more added together. Or maybe the person who sold for $1 million identified property 1 at $1 million, property 2 at 1.1, property 3 at 1.5, and their plan is to just buy 1, thereby having backup plans. And I know the next statement is going to be, well, what about inventory? What if something comes up and it's gone? That is a problem within the 1031 exchange. That's why it's great to start looking ahead of time to set your client up for success. Again, they can be in contract with both properties at the same time, right? Now, the second rule is classified as the 200% rule. That allows the exchanger taxpayer to identify any amount of properties, but the sum of their fair market value cannot exceed 200% of what they've sold, right? So, example, I sold for $1 million. I identify 6 properties. So I breached 3. If they use that format, the 6 properties cannot exceed a sum of $2 million. Where did I get that number? 200% of $1 million is 2 million. That's what I sold, right? So you're using these for maybe a different type of investor, someone who wants to diversify beyond 3. Great. And the last rule is the 95% rule. This rule indicates that they can identify as many properties as they would like. However, they have to close on 95% of what they've ID'd. So say they write down 10 properties and they close on 9, can't close on the 10th. They have a blown exchange now because they didn't close on 95%. Can't close on half of the last one. So I would stick with the 3 property rule for residential. Identify up to 3 regardless of their fair market value, the list price, who cares, right? You're stuck with 3. That's what you have. Think of them as diversification or backup plans. Thank you for the question. Okay, pitfall number 2. Not understanding the requirements for full tax deferral and what are partial exchanges. So for full tax deferral, and to me, this is always the goal. If I'm going to do an exchange, my goal is to buy more real estate, right? That's my number 1 question to all my clients. Is your goal to buy more real estate? Absolutely. Well, then a 1031 makes sense. Why pay a dime in capital gains taxes when you can use the entire investment to redeploy it into more real estate? So this person who wants full tax deferral has to reinvest the net proceeds. The net proceeds, let's look at that. My sales price minus closing costs. That's the value of real estate that's left. So I'm selling for $1 million. Let's say closing costs are 5%. That leaves me with $950,000. I need to buy something for at least $950,000. Now let's say that property of $950 doesn't have a loan, it's still $950, right? If that property is encumbered by a mortgage, right? They have to pay off the loan through escrow. Let's say it's $500,000. They pay the bank $500K. The net exchange proceeds are $450,000 that are wired into that segregated account held by the qualified intermediary. So what we're doing there is holding the net exchange proceeds, and this requirement states they must reinvest that net exchange amount of $450, right? But they must have the same or greater amount of debt on replacement property. So the $500K has to be replaced. So going all the way back, the value of my real property was my $1 million minus my expenses, also known as closing costs. So I'm at $950 again. Even though there's only cash in the amount of $450 held at the exchange account, I still need to obtain a new loan of at least $500 or greater. I can always bring my own cash in to offset my replacement of debt. Say I'm going to bring in my own $500K. My value of replacement still equates to my $950. So that works. If for some reason that client says, hey, it's $950 and I want to buy something in the amount of $800, that works. It's a common misconception that it's all or nothing. That's not the case. So this client sold for $950, bought for $800. That means they have $150K left over, right? $150K cash, let's say. That $150K cash would be wired to that exchanger after closing on their final replacement property. It's now taxable. A lot of the time exchangers, the last couple of years I've seen it more frequently, where exchangers will say, well, I want to take $100K out right out the gate. So when I'm closing on my relinquished property, I want escrow line item on my settlement statement showing $100K going to me, the seller, the remaining to go to the qualified intermediary. Yes, that works. Now they're getting cash up front. The rest is going to play, right, in the game of Monopoly to find replacement property. So anything that's non-like-kind real property in an exchange, we call it boot. Boot like on your feet. It's personal property. I can hold boots. I pay taxes on boots, right? Boot is taxable. I can move it around. I talked through an equation, again, visually. Here's another one. This person sold for $900K. They had a loan of $300,000 and costs of sale, closing costs, right, are $60,000. Those are your commissions, title, escrow, transfer, recording. So the net equity is going to be $540,000. They have to reinvest the net exchange proceeds and acquire a property with the same or greater debt. The replacement property, you find them, is $1.2 million. So now we're going, our trajectories up, right? Going up in value. So when I look at the value of what this person needed to replace, I would take my debt of $300K plus my $540. So this person needs to buy something for at least $840,000 for full tax deferral. But they can go same or greater. The replacement property loan was now $660K because they needed more to buy that property, of course. Hey, Kayla, wire over the $540 with your team at Leader. We did. $540 goes out. Now they're at a total purchase price of $1.2 million, right? So the QI played part of using the exchange proceeds. The lender brought in the remaining $660, totaling the full purchase price at $1.2. This person did not pay a dime in capital gains taxes. Another way of saying it, they had zero boot. So when your clients are asking you, well, what do I need to buy for full tax deferral? What's the goal, right? The goal for full tax deferral is that net plus debt or sales price minus closing costs, zero boot. Just switch slides very quickly there. For those of you that can see it, I hope you can, really, really do. This person wanted to buy something for $700,000. They didn't replace the loan completely, so they got a loan in the amount of $260,000, went down by 40. So now they have mortgage boot in the amount of $40,000. Even though that loan of $40K doesn't exist, they still owe on that amount. And they say, hey, Kayla, let's only wire over $440 for the replacement. That leaves us $100,000 in cash boot. The total of taxable boot here is $140,000, the mortgage portion plus the cash portion. Right? This is okay. This person did that partial exchange, right? They wanted to exchange them, take some cash out, take a little hit on capital gains taxes while also utilizing IRC section 1031. Oops. Questions on pitfall 2? Value replacements, partials, loans, offsetting debt, cash. Okay. Moving forward then. So pitfall number 3, selling or exchanging into a property that is not held for investment, used in a trade or for business purposes. Well, I want to do an exchange and I'm going to buy a personal residence. That does not work. When you buy a personal residence, right, you're then indicating it's a primary and you're getting tax advantages under Internal Revenue Code section 121. That will raise a huge red flag by the IRS. On average, about 3% of exchangers are audited a year. California, more. Meaning majority of that 3% are audited in California. But of course, right? So what is excluded? What can I not exchange into? We talked about principal residence multiple times. Property held for sale. Those are known for dealer flips, right? This is like dealer property. So flips. Their intent has to be holding the property for investment. If my intent is to make a quick buck and flip a property, that's not a long hold period. So held for rule. On average, CPAs recommend a year and a day on the minimum, up to 2 years, which is more conservative for holding investment property prior to 1031 exchanging it. You cannot exchange into stocks, bonds, notes. We talked about interest in a partnership. Again, no flips or no REITs. Patricia has a question. Yeah, we do have a calculator on our website, leader1031.com. So we do have our calculator. It's an investment calculator looking at net and debt, replacing it, capital gains, all the above. So this is our option to send to clients, right? When we can't give that tax advice, and they can play with their numbers. So qualifying real property, right? The relinquished property is held for productive use in a trade business or for investment. We got to remember the replacement must be an investment as well. So some fun nuances here, covering the like kind of tenants in common or a Delaware statutory trust, which is both a security and real estate, can be identified as a 1031 replacement property. They can sell land in exchange for a cabin, maybe up in Mammoth, right? They can take oil rights, mineral rights, wind turbines, a duplex, triplex, right? Fourplex. All of these can go across the board for one another. So if someone wants to get out of Landman, it's a great show, right? But Landman and owning these land oil rights, mineral rights, they can exchange into maybe a duplex. Right? We talked about that person maybe selling an investment property, a couple SFRs, and buying commercial and running a coffee shop. That works. You're not limited to, I sold a condo, I have to buy a condo. Questions on pitfall 3 of like kind before I move on, and then we're going to take a little break after this, just for like 2-3 minutes. Okay. If things come up, questions about like kind as we move forward, please fire away. So pitfall number 4, using a person who's considered disqualified as an intermediary. So a taxpayer cannot have a family member, employee, real estate professional, legal tax advisor, right, an attorney, for the last 2 years function as a QI. We're a person who is a non-disqualified agent to the taxpayer, which is so funny because non and dis, 2 negatives, we're qualified, of course. So what our goal is in creating these documents, right, is really these safe harbor regulations, which is a term under our tax code. So we are the safe harbor space representing the exchanger taxpayer to utilize Internal Revenue Code section 1031. That includes that exchange agreement, the assignment, the segregated account that we hold at Leader 1031, making sure all those are set up, right? So our goal is to expressly limit the taxpayer's rights to receive, pledge, borrow, otherwise obtain benefits of money or other property, right? So what we're doing there, holding the cash for a short amount of time, moving it over. That is our role. Mom can't hold it, your employee can't hold it, a friend can't hold it, it must be a qualified intermediary, fiduciary responsibility, right? Broker, relatives, investment banker, accountant. I think I kind of covered all of these. When preparing the exchange agreement, I mentioned that assignment multiple times. We also have a notice of assignment or an NOA on the buyer side. So when our exchanger goes from selling to buying, we have an NOA. We communicate with escrow and title on both sides of our exchanger's transactions, the relinquished and the replacement. We give them instructions on how to coordinate the settlement statement and indicate it that it's recorded correctly, qualified intermediary, on behalf of John Smith. So levels of QIs, I have this here. This is just something important for a takeaway. Ask tough questions on behalf of your clients to the QIs you're interviewing. QI, qualified intermediary. That means, where's the client's money being held? Is it in a segregated account? Do you have insurance? Can we see the account as soon as money hits? How long do I have to wait for receipt of funds? These are all really, really good questions to know, because guaranteed your client is going to ask you that. Where's my money being held? I mean, I would. We are backed by the FEA, Federation of Exchange Accommodators. If a qualified intermediary is new in this space and you really want to work with them, my advice is to go on this website and search up their company. This is a stamp of approval. We get knowledge daily, education, all of these things to participate in the 1031 space. With that being said, qualified intermediaries are non-regulated on the federal level. That's wild, right? So making sure that there's a little bit of a track record, let's hope there, and history, and that they are part of the FEA is a key for your success as a realtor. We're also backed by the FDIC, since we are operated at the highest level of security of funds for a bank. So ask these questions. It's good to know. All right, I'm gonna do a quick pause. I will be here. I'm gonna just look at my watch. Just give it 2 minutes. We're looking at time zones. I'll see 10, 20. Let's go. We'll just go at 11. Okay. So I'm just going to be hanging here. If anyone needs to get up, use the restroom. We only have 4 more to get through, and then I'm going to open it up for more questions. But if you have questions now, fire away. Okay. Back in action. I don't see any questions in here. That's okay though. Hopefully that means I'm doing my job well. So going back into it, we stopped at 4, going into 5 about CPAs that I covered briefly early on and the importance of this. While meeting with your client and talking to them about the value of what they need to replace on the replacement property, it is crucial that their CPA does bless their exchange. Usually if a call comes in for me saying, hey, so-and-so sent me your way, my realtor sent me your number, do I qualify? I'll ask some great questions. Have you owned the property for at least 2 full years? Has it always been an investment? Is it rented? What did you buy it for? What are you selling it for? Those are pretty good indicators that it can be an exchange property on the basic level. Sometimes we get into situations where people are on title in that partnership and they're not sure about replacing it with another partner. How do we set that up? Can we split it? Can we talk to the CPA? Maybe this was just created. Maybe their CPA tells them absolutely not. This property was a primary 2 weeks ago, right? And they moved out. Now they want to sell it, list it, and exchange it. So it's always good to find out how they're filing their taxes on that property because you and I won't really know the answer to that. That was a quick one, right? Not handling partnership LLC issues properly. So when we're looking at an LLC on title, and these are very, very common for people coming out of East Coast property and buying into West Coast, they need to sell in that LLC and acquire in that LLC. If, let's say, my friend Mary and I decide that, we've created an LLC and we're on title, I want to exchange and she doesn't want to exchange. If that happens, we can either do what's called a swap and drop or a drop and swap. Right? So a drop and swap would be Mary and I discuss, all right, I don't really need to sell it right now, even though I want to. Let's drop title and then we're going to swap properties. So a drop and swap, what we're going to do is say we're going to dissolve the LLC and go on title as tenants in common. So now Mary and I are 50-50. Kayla 50%, Mary 50%, tenants in common. We hold that property now for an additional year and a day, indicating our intent was to hold. Then we list the property for sale and we exchange and go our separate ways. Maybe Mary just wants to cash out. She can take her cash and I want to keep rolling my exchange and building that wealth. I can do that. Maybe we do the other route of the swap then drop. Mary says, oh, I know you really want that replacement property. We've been friends for years. Let's just exchange into it. What we could do is then maybe say our 50-50 LLC that we're members of, the Kayla Mary LLC sells. Kayla Mary LLC maybe buys 2 properties. One that's mine, even though the LLC is on title, and one that's Mary's, even though the LLC is on title. We've split it 50-50 for the valuation, right? Then after a year and a day, we can dissolve. She can outright sell. Same concept if we were to buy the same property. I can always buy her out, right? So this is a win for some, but anytime you're looking at an LLC partnership, and if Mary we were to outright sell the LLC and Mary sells her portion, she says, no, I'm cashing out. I don't know how familiar everyone is with LLCs. We would all receive funds for that and pay taxes on it based on how we are vested within that LLC in our shares. So it can get complex. However, that's what I'm here for. We can talk through how they're on title, look at any different documents that they have supporting maybe in a irrevocable trust, a revocable trust. Is it a disregarded entity, regarded entity? And we can navigate together how you can successfully draft that RPA or listing agreement and know who's actually doing an exchange, who's actually cashing out, and how that can be a benefit to your client. I think I've kind of taken a deep dive into this one, so I'm sure we're covered. Oh, thanks, Patty. Appreciate it. All right, pitfall number 7, not evaluating the entire exchange transaction on both sides. right? This is that value of real property. If my list price is going to be $1 million on my sale, do I need to buy for $1 million? No, right? Let's not forget closing costs. It's really good to be knowledgeable about that evaluation that we had, up on the screen showing sell for 900, owe the bank 300, net exchange, I believe it was at 540, and then closing cost was 60. Yes, good math. So if that's the format, you can calculate and sit down with your clients, right? And say, this is what you need to buy for full tax deferral. Evaluate where they want to go, set them up for success, dream with them. This is the whole point of the 1031. Let's dream and grow it. Of course, I'm missing on this last bullet point here, so I'm going to just touch on it. Adapting to the challenges of current market conditions when inventory is low and properties go under contract very quickly. If, let's say, you find them replacement property right now, today, and their relinquished property is listed with you, but there's no buyer in contract, you can make that offer on their behalf. And of course, within 72 hours, they need that earnest money deposit. They can use their own personal funds as an earnest money deposit to get into contract as a contingent exchange buyer on that replacement property. Maybe it's a hefty EMD. And don't forget, there's going to be other offers. Don't forget, this is an exchange buyer. If that seller's agent is versed on 1031, and if they're not, we'll verse them on 1031. They know the timeline restrictions. They know the identification rules, right? So that's the best possible buyer, an exchange buyer. We want them to buy our property, especially if you're repping a seller that an exchange buyer is coming in. So if they were to front that earnest money deposit out of personal funds, once the relinquished property sells, let's say that $1 million sale is now moving over, and now we're transferring it over to the segregated account for the QI, then over to the replacement escrow. We can offset the original earnest money deposit. So what I mean is I put 40 in, but 40 is going to come from my exchange. So at close of escrow on the replacement purchase, the 40K goes back in my pocket tax-free. So I'm just fronting it here. It's going to be replaced once the exchange moves forward. A little trick there for the win. What are closing costs? Huge question. Comes up all the time. Broker commissions, right? Exchange fees, transfers, attorney fees, recording fees, insurance fees, escrow, all of these are closing costs. If someone says, I repaired my property, I put in 50K in the kitchen, I want that money back. In a 1031 exchange, if you take that 50K out, even though you fronted it to improve the property, you are facing cash boot or a taxable event on that 50K. You can do it, right? We talked about that partial exchange, but they will be facing a tax consequence on the portion they take out on repairs. Prorated rents, credits, right? So all of that is to be excluded as a closing cost or exchange expense. What are capital gains taxes? The big question, big money item, right? So if I sell for, let's say I bought for $1 million and I'm selling for $2 million, that means my cost basis is $1 million. My sale price is $2 million. That means my gain is an additional $1 million, right? Just quick math. So I've owned it for 20 years. Now I have $1 million gain. My depreciation recapture tax will be applied to my $1 million gain. That's at 25%. So if that person outright sells the property and they've depreciated the property, let's call it $100,000, it's probably more, but $100,000. Now they're paying 25% of that back. Isn't that fun? We got the advantage of it, but now we're paying it back at time of sale. So it's $25,000 off the top. And again, most likely it's more. The net investment income tax is applied to that $1 million gain. That's 3.8%. Healthcare tax. Federal capital gains taxes. Could be 15%, could be 20%. So when you're looking at 15 or 20%, that's really contingent on the earnings of the investor, specifically the investor, right? So they could be in the 15%, 20% threshold. Who do we ask for? Their CPA to tell them, right? I don't even know their income. The applicable state tax. Does anybody know the capital gains state tax in California versus, let's say, Tennessee? See if anyone can answer that one. I'm looking for either California capital gains, and I'm sure you guys are Googling, which is fine. California capital gains versus maybe Tennessee or Florida. No takers? Correct. Okay, so we don't have sales tax, right, on Tennessee. But when we're looking at zero capital gains, when we look at different states, why is Tennessee, Texas, Florida, right? All of these states are so popular for people exchanging into. We're looking at state tax capital gains. California, Justin said 9.3. We're actually 13.3% capital gains tax in California. That's the highest in the country. I put down here Massachusetts as well, so you can see the scale of like an average state of around 5%. We're way higher at 13.3%. Now that's base. Then we have the millionaire tax that's going on after that, right? So you could be upwards of 14.5, but generally speaking, 13.3%. So let's do the math quickly on these components. I've got 13.3 California state where I'm selling my property out of. Then I'm a high earner. I'm going to say I'm paying 20% for the federal level. I'm already at 33.3 that I'm paying in capital gains taxes, plus my net investment income tax, right? So now we're in 37 ballpark plus depreciation. Let's say we're at 40% capital gains taxes to do a traditional sale. So I held this property for years and I made $1 million gain on it. When I sell that $2 million building, or let's say residential and investment property, my rental, my number that I'm going to be netting could potentially only be maybe 1.5 after closing costs, because I'm paying capital gains taxes in the amount of 40% on my gain of $1 million. It's 400 grand. That's a lot of money. So if that person, again, you put on your real estate investment goggles and you think, I want to buy more real estate anyway, why am I going to pay capital gains taxes with these 4 levels, right? When I want to defer it and buy more real estate. So thank you, Lupe. You got it. 13.3. So good pitch there. That is a lot of money given to Uncle Sam. I agree. I agree. So any questions on this last one? I'll go back. That was the capital gains, exchanging closing costs, net investment income. Okay. So I think we're understanding here why, what's in it for me? Well, you're deferring that gain. That swap till you drop statement early on. If you exchange and you exchange until you die. Now, let's say I have 10 doors in my lifetime and I'm getting rental income from all of them, and maybe I have alternative investments as well. When I die, my children would get a step up in basis. They can sell my property that my husband and I have grown our portfolio and exchanged outright. The capital gains taxes go away, right? Pretty neat. Same concept if I diversify and I sell 1 out of the 10, now I'm only taking a small hit on 1. Rather than selling that one big property and there's that 400 grand gone. Pitfall number 8. This is a very common strategy in California and Texas, is generational wealth of related party transactions. See it a lot in the Irvine area, in Chula Vista area, El Paso. There's a lot of generational wealth of land and farmland, Temecula, even Riverside, where people own a lot of land and it appreciates. Then they want to figure out how to keep it in the family. So here's an example, real life example. In my early 20s, I was living in one of my mother and father's investment properties. It was a condo in Oceanside, so just south of San Clemente. Beautiful beach condo. He exchanged into it. I lived there for about 4 years and I wanted to buy it from him. He then wanted to take the cash and pocket it. That is a no-no. I cannot do a related party transaction with my dad, even though I'm outright buying my primary, since he's not exchanging out and he's a related party to me, he's a family member, he's gonna then pocket that cash. What's gonna stop dear old dad from gifting me inheritance monthly out of the money I gave him that's tax-free? So if scenario, dad didn't exchange, let's say Kayla bought Mike's property. Mike did a 1031 exchange out into land in Texas. That would work. It only works for related party transactions when no one is receiving more than 50K cash in the exchange component. So related party transactions can get sticky. Just remember to ask those questions, because sometimes we get to that close of escrow and it's the same name, the buyer's switched and it's someone, or the seller switched and it's someone else's name and they're related. And that's a huge red flag by the IRS. Any questions on related party before we get into the last one and then questions? So we're about a little over an hour here, which is good. Okay, pitfall number 9. Okay. Correct. No more than 50K. Pitfall number 9, not understanding reverse exchanges. We call them parking arrangement transactions. So a parking arrangement, why parking? Because we're essentially parking a property. We're just leaving it on the side of the road, if you will, right? We're just leaving it there. How do we do that? So in a reverse exchange, there's low inventory. Someone sees a property that came up that they've been waiting for forever, and they call you. Hey, I'm ready to jump on it, Justin. Help me get this replacement property. So you make an offer, you write an offer up for them. You're now accepted. Even though Mary went on title as far as her offer, she's not on title, she was in the offer as her name. At close, we would set up what's called, through our exchange accommodation title holder, we would create a brand new LLC on behalf of Mary. Call it Mary LLC. That's now parked on title. So at recording, Mary LLC is on title, not my client's social security and tax paying ID. So we're parking it here. Day of close of escrow of this replacement property, she has 180 days to sell her relinquished property, which she just listed with you. Pretty neat, right? So you're doing it in reverse. You're acquiring the replacement property first prior to selling the relinquished property. Now, where does the money come from? The client. They need to come up with enough cash or talk to a bank to be able to get financing to buy that replacement property outright under Mary LLC. And it's probably, I think we're on trees this year. It's like Oak something LLC. So we just go for different variations of random shelved LLCs. So it's this shelf LLC that just goes on title. You list the relinquished property. Once that sells within the 180 days, the exchanger then puts that cash back in their pocket, maybe pays off a bridge loan, right? At that point, we can then, she can take assignment to Mary Oak LLC, or we can change title into Mary's name. So that's a parking arrangement. We're putting a property with a different entity to free up the ability to do a forward exchange with the relinquished property, right? Pretty fun. So the improvement exchange is very, very common. Not so much in California, depending on how extreme it is, but it's pretty common for someone who maybe is exchanging, selling $1 million, and they buy something for 700. They have leftover cash, let's say around after closing costs on the relinquished property of around 200 grand. If there's 200 grand left in that exchange account, they can draw on those funds to improve the replacement property. Maybe it needs a new roof. Maybe it needs new foundation, electrical. So long as those repairs are completed by day 180 of their exchange and they've identified it, this works in an improvement exchange. And of course, that replacement property will be recorded in that LLC for them to draw on. Once it's completed, they re-record in their name. So they're identifying this new property, drawing on it, improving it, using all of the funds rather than paying boot on the 200 grand in my example that was remaining. A built to suit exchange, again, not really done so frequently in California because of applications for permits and codes. But this is where someone would maybe sell for $1 million, buy land for 500, then build something from the ground up, built to suit. Typically those take about 6 months to a year to get permits and approvals, unless they're already working on that. They have another property they're exchanging. I have a question here. In California, can you rent your 1031 exchange property to your children? Any red flag? Yes, you can, Patty. So I did do that for 4 years. I paid, within reason of fair market rent to my parents when I was in my early 20s. When I moved out of that property and got married and went my own way, my parents exchanged that property into other property, right? So they were just really holding it for me as a rental to be in the area closer to them while I figured out my life. So that's a benefit. A lot of our clients do that. Thank you for the question. Okay, here's another one. If built to suit exchange allows long time, 2-year. No. So again, the timeline is still intact for how long you must complete it. 180 days. So if I close on my relinquished property today, and then I close on my replacement property land in 2 weeks, I still have some timeline left, a lot of timeline left, right? To complete the built to suit, but it's only 180 days from when I sold. That's why it's really tough, because if you haven't even applied for a permit to build anything, you're way behind the curve. I do have clients that have exchanged into land and then taken their cash, taken a portion of cash as taxable boot, and then improved on the property over years. It took them 2 years to maybe build a primary residence. Their intent was investment, right? After 2 full years though of building, they then moved into that property and claimed it as a primary. You can do that. Good strategy. I exchange investment property, buy somewhere that I want to retire in 2 years, hold it as an investment, maybe a vacation rental, a couple weeks to this party, a couple weeks to that family member. After 2 full years, I can then claim that as a primary and move into it. I can also claim it as a second home where it's just personal use after 2 years. Highlights of the delayed exchange, just wrapping up here, and start firing questions if you have them. We can go through those in just a minute. Consult with an experienced qualified intermediary, that's me, or a tax advisor, legal tax advice prior to closing on the sale of a relinquished property. Ensure that the sale contract is assignable. Again, the assignment is what we create so that the buyer is made aware of such assignment in writing. We do have that assignment that the buyer does need to sign off on, not required, but really, really desired, so that we can have that when they file their taxes. The 1031 exchange cooperation clause should establish the intent to perform the 1031, which you have in your seller's intent to exchange forms. You're releasing that buyer from any liabilities or costs resulting from the exchange. We need to notify the buyer in writing of the assignment to a QI. All of these need to be done just for what's behind the scenes in our role. It's not just holding the money, it's preparing all the literature so that it's documented correctly for the exchanger. We have to reinvest net exchange proceeds and acquire a property with the same or greater debt for full tax deferral. You can do a partial exchange, right? You can have a little leftover, pay some taxes. That's okay. The taxpayer must identify the replacement property to be acquired in accordance with the rules of identification within the 45 calendar days. If I don't identify within 45 days, the cash that the qualified intermediary is holding is wired back to me on day 46. So this could also be a great sales pitch of an opportunity, right? When we're thinking about how to land that listing, how to educate our clients, how to be the best at what we do. Well, this is an opportunity to an exchange. I can help you try to find replacement property. It's buying you 45 calendar days. The taxpayer must close on the replacement property by the 180th calendar day or their tax filing date, whichever is earlier from the close of the relinquished property sale. That covers all of the highlights. this is my contact information. If you do have questions, I know it's on that handout as well. There's our website, my email, my cell phone number, text call, all the things. I'm going to leave this up for a sec, and I have one question here. Thanks, Justin. Just to confirm, if a family member sells their primary residence to another family member for personal use, is there any way they can avoid capital gains taxes? So again, primary is kind of irrelevant here for 1031. This would be in my example, I'm buying from a client or I'm exchanging into maybe my brother's property that's his primary. He cannot end up with cash. That doesn't work. So if I'm doing an exchange into my brother's primary residence, if he puts cash in his pocket, it's going to raise a red flag because it's a related party transaction. If that property that I was exchanging into was an investment property and I exchanged into my brother's property, he could then exchange out into something else. So that works. As far as personal use, if I were to outright buy my brother's property as my primary and his was an investment, he could then exchange out. Yes, that's the only way, is if I'm using it for personal and he's exchanging. So there's really no cash that my brother's holding from my sale, or from my purchase rather, and he's not touching it to gift it back to me. If you think about it, anytime there's an advantage to move money back to a family member, it's going to be a red flag potentially. I like to drive in between the lanes, so. Well, I really appreciate all of you dedicating your time this morning. Sorry for the slow start. I know I'm getting time off right now. I'm doing 11 your time right now. So you get right? 11 your time. Yes. So we're getting time back, which is fantastic. I'm traveling right now, so I apologize. My brain's a mess on where we're at location, but I truly, truly appreciate it. If you have questions, personal scenarios come up, client scenarios come up, part of your own line, just give me a shout. I'd love to help. And this is like one of my favorite things that I have about my job, is just teaching you guys and being part of it, watching you grow. So thank you again so much. Really appreciate it. I'm going to hit stop share here. And I hope you guys just have a lovely, lovely rest of your week, and hope to talk to you soon. All right.